Hello, everyone. Welcome to today's webinar with me, Fawad Razaqzada, market analyst with Think Markets, and my colleague Victor. We are going
Hello
to.
there.
Hello, Victor. We are going to talk about what's happening in the markets very briefly, and then go straight to the charts. But for those of you who are new to this webinar, basically, we like you guys to ask us lots of questions. Because we want to talk about things that you guys are interested in rather than us talking about things that you might not be very interested in. So please keep those questions coming. Before we begin then, let's go very quickly through the risk warning. So these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So, what's happening today then, Victor? We saw a big rally in the markets, didn't we? I think we can go straight to the charts of indices and look at something like the DAX. Big rally today, 1.8%, 1.9%.
So what has been going on is basically a mixture of headlines out of Russia that have, well, over the past couple of weeks, we have been getting these reports from US intelligence that Russia plans an immediate attack on Ukraine. This has hammered this every time we got a report like this has hammered stock markets and sent oil prices in a vertical rise. So what happened is this morning is that the Russian Defense Ministry came out with an announcement that its troops are returning to, well, most of its troops are returning to their barracks, and thereby all the speculation about an imminent war in the Ukraine, with Russia attacking the Ukraine, something that has sounded quite unlikely, turned out to be unlikely indeed.
Do you think then the markets had overpriced those risks of an attack on Ukraine or invasion, I should say?
They have been overpricing these risks over the past couple of weeks, and now we have established a new ground, I would say. But that said, I wouldn't be that there is no long-term solution to this matter as of right now. So yeah, anything is possible at any point in time. Remember that. That said, the Russian parliament this morning voted on recognizing the independence of two separatist republics in the Ukraine, which have been a focal point of discussions between the Ukraine and Russia. So that could steer some more some more controversy in the coming weeks, but it appears that the Russian invasion is not on the table, and it would appear that for now this imminent threat is reversing numerous trends, such as stocks lower, oil higher, And for a very keen bunch of traders, gold has reversed its recent rally.
Yeah.
And is now testing the base levels from yesterday. Let's see how that goes.
So yeah, I mean, it's been risk on, in other words, hasn't it, this morning? So stocks rallied.
Yeah.
Gold has sold off. Crude oil, which had been rising quite sharply on the back of those geopolitical tensions, have now come back down. It's not the end of the bull trend for crude oil, I don't think, because it's not just those geopolitical tensions that had been supporting oil prices. You know, the OPEC plus, I should say, they are clearly struggling to meet that 400,000 barrels per day increase in crude oil that they have that they are planning every month. A lot of OPEC countries are struggling to meet that target, so there's less supply of oil coming into the market than expected. That's keeping prices supported on the dips, and you know, geopolitical risks are not completely gone away. So I wouldn't be surprised if oil prices were to stabilize around current levels, 93 to 93.50 area on the Brent contract, which was previously resistance, could turn into support. Gold, yes, it's gone down after you know, breaking out the last week or so. The trend is clearly bullish for crude for gold. It's staying above the 200-day moving average, and it's taken out the resistance trend of this triangle pattern. So for as long as it holds its own around the 1850 support area, which was previously resistance, this would keep the bullish traders happy, I would think. For me, the key level, the invalidation level, if you like, is at 1820. So for as long as it holds above 1820, I think the path of least resistance would be to the upside. The reason I say 1820, it's because it's the base of the most recent breakout from the triangle pattern. So if this is a bullish breakout, which I think it is, there's no reason for gold to revisit 1820 again. But if it comes close to 1820, then that would be a bearish sign, in which case then it would probably open the way for a bigger drop. But for now, things are looking bullish for gold, not just on the daily, but if you look at the weekly chart as well. You know, last week we broke out from this bull flag pattern on the weekly time frame, despite rising bond yields, which is something very important to mention. So whenever bond yields rise, it tends to weigh on gold prices. But right now, I think people are more focused on real yields rather than just nominal yields. What do I mean by that? Well, inflation is at 7.5% in the US. And if you look at the 10-year bond yield, just give me 1 second. It's this chart here. So yields are on the rise. They have broken above 2% once again. So this is something that could come back to haunt technology stocks, by the way. But if you look at the bottom of the chart right here, you can see that real yields, that is nominal yield minus the rate of inflation, which is 7.5%, gives you a rough estimate of around negative 5.5% for real yields. So because this is a negative territory, gold investors have been able to or willing to ignore rising yields, rising nominal yields for now. So this is why gold has paradoxically, if you like, risen alongside bond yields because of the fact that real yields have been in negative. So obviously with central banks tightening their belts around the world, not least the Federal Reserve, we would imagine that nominal yields will catch up with inflation, right? So although the 10-year might not rise to 7.5%, which is the current rate of CPI inflation, I think there's a good chance for yields to close the gap to like 3% in the next few weeks or months. and that should help to lift real yields off these lows. And in doing so, it may derail the rally in gold. But for now, I reckon the path of least resistance is to the upside for gold. Sorry, Victor,
Right.
didn't mean to cut you off there. Were you saying something?
Yeah, no, not really. You haven't cut me off. I'm just yeah, the recent price action in gold has certainly been range bound if you look at it on a longer term perspective, and we did hit this morning the 1880 or thereabout level, which basically 1877, but I think the peak was around 1880. So that was the last resistance, and it worked rather swiftly, and we are seeing a $30 pullback already from the highs. So if you want to try long positions, I would advise you against doing that right here, because because this move can extend for a protracted period of time. Because we have bumped into a major level, so these levels are quite significant, and I would say that it would be a risky proposition to attempt any long positions here, despite
so basically
the recent breakout. I mean, the first support after the breakout was basically rejected in this violent manner. We're continuing to see gold sell off along with silver, and that's something to look out for, and just be careful about if you're too bullish on gold.
So basically, one way, if you are indeed a bullish speculator or investor in gold, perhaps it might be best to wait for the dust to settle a little bit here. Maybe zoom in on the hourly chart and look for some bullish price action before potentially stepping in on the long side. Or if you're a bearish speculator, it may make sense to wait for a clear reversal pattern. I know this is a interesting pattern that's being formed right now, but the day has just started, so things could change later on, especially because we have more inflation indicators coming out from the US in the form of PPI or Producer Price Index at 1:30 GMT. Speaking of inflation and central bank response to inflation, this is what's keeping me slightly
awake
bearish towards awake at night. No, it doesn't keep me awake at night, but it does keep me slightly tilted towards the bearish side of things insofar as stock markets are concerned, or specifically technology stocks, because yields are rising. If you look at the dividend yield on the NASDAQ, it's can't remember the exact figure, but it's surely declining because of the fact that people are getting a real alternative in terms of yields in as far as government bonds are concerned. So for as long as this thing keeps rising, I think that this will weigh on the appeal of technology stocks. But it doesn't mean that all sectors of the stock market will suffer. Certain sectors like banks are likely to benefit as yields continue to rise, because banks will be able to charge higher interest and therefore make better profits when yields rise. So that's something to watch out for, whichever market you trade, but particularly technology stocks.
All right, so shall we have a look at oil prices?
Yeah, sure. Let's have a look at oil prices. Which contract? Crude. We looked at the Brent, didn't we? This is the WTI. Oh, which one would you like to?
Yeah, I tend to look at the WTI because it's the exchange traded contract in the US. So what we saw yesterday was another peak, another clearing of stops above sorry, I cannot see your chart very well. Yeah, above 95. And
yeah, 95.
That triggered some stops, and after the flush of these stops ended, we have reversed this morning on the same headline that Russia is pulling back from the borders with Ukraine.
Yeah.
And what do you think? How does it look from a technical perspective? Is there a chance for the bears to make a more sustained, move lower?
I think there's obviously the risk that, or the chance that this might happen now in light of the escalation of the geopolitical tensions. I think that there is a good chance, but from a purely technical point of view, I don't think we've seen that reversal pattern yet. I think we will need to see a clear reversal in the form of a lower low before we turn bearish on oil prices. Because at the moment,
so that means below 88.44 on
that's
your
correct.
chart.
Yeah. So a break below that will give us the first lower low. That doesn't necessarily mean that you should short it straight away. If that happens, then what that will do is it will mark a breakdown in the structure of rising prices, which then means that any potential rallies back into resistance in the future could get sold into. So, so I'm being very hesitant to turn bearish from a technical perspective on crude oil, just because of what's happened today, because it is a very headline-driven move, but we do need to see that breakdown below 88.44 as things stand before possibly looking to the downside. So that's the situation. I think when a trend is this strong with prices above the 221-day exponential, making higher highs and higher lows, etc. It makes sense to wait for a reversal rather than anticipate the reversal, even if the fundamentals tell you otherwise. So yeah, for me, a move below 88.40-ish would be the trigger. That will obviously also take us below the psychologically important $90 handle as well, which is important.
Right. Okay. So shall we move on to currencies?
Yeah, sure. Shall we? Before moving on to currencies, let's finish off indices because we touched on them briefly. If that makes sense, yeah.
Sure.
I spoke with about the NASDAQ 100, bond yields rising, etc. The NASDAQ is clearly underperforming the global indices because of the overvalued technology stocks in the index. Following today's bounce, it's now retesting a major area of resistance, this shaded region. You can see a lot of price action taking place around here. We bounced previously resistance here. Support there, support again. We broke below this zone on Friday before bouncing back at the start of this week.
Looks like an ugly chart.
It does look like an ugly chart. So I wouldn't be surprised if the NASDAQ were to resume lower from here. But in light of the big rally we've seen in the stock market today, with the NASDAQ futures being up 2%, what you want to do is you want to see a clear reversal pattern on the lower timeframes, like the hourly chart. So to show you what I mean, something like this, for example. Okay, so in here we had a move up, which should have held if that was a genuine move above this candle right here. But you see how that failed, and we broke below the low of that consolidation area. So something like that is what I'm looking for here on the hourly chart. So we've got this clean move up, and if we get a nice reversal here, something similar to this, that could be the trigger, or one could wait for a confirmation below this zone to turn bearish once again. This area was is the base of the today's move up. So there's no reason for the market to go below that area if things are still bullish, right? Therefore, if that happens, then you know that the bulls are in trouble because they've been caught here in this rally. So conservative traders may wish to wait for that to happen before potentially going short around this area, whereas more aggressive traders may want to look for bearish patterns to form around current levels in order to take us down to at least the base of today's breakout, and then the extended target could be below this week's ranges, or so on and so on. So there's lots of ways to get on board. The key point I'm trying to make is that we need to get that trigger, that short-term trigger, before looking to possibly short this market. Yeah, so similar price action is evidence in other technology-heavy indices. We saw the DAX struggle. It's been struggling for the last year or so. The German DAX hasn't really gone anywhere.
Right. Yeah.
And if you look at
these these strong support levels around 14,800 and 900. Basically, just below 15,000. It has proven to be quite a strong support area, and it's been resilient to any kind of fundamental news.
Indeed. And if you look at the German DAX, the technology, it's called Tech DAX, right? It's an index of the top, I think, 30 or 40 technology stocks in Germany. Not quite sure. But this index has been clearly showing underperformance, like the NASDAQ 100. But if you look at something like the FTSE 100, which is a commodity-heavy, bank-heavy index, you can see the FTSE is not very far off from its recent highs. So this shows that this current market is not all about risk on, risk off. It's about sector rotation. Technologies clearly underperforming because of rising yields, but banks are doing well or relatively better. So depending on how bullish or bearish you are, you need to select the right market to trade.